Welcome to the Nifty Noon podcast. If you've been paying any attention to the screens lately, it has been an absolutely wild ride.
Oh, yeah. Wild is definitely an understatement.
Right, so today we're bringing you a high-level summary of the dominant themes we've been tracking all week in our newsletter. And the core narrative, the big TLDR for you to take away today, is this. This was the week the walls between traditional finance, what we usually call TradFi, and crypto completely crumbled.
They really just fell apart.
Completely. We're talking about 247 on-chain markets, proving they are absolutely vital during a weekend geopolitical crisis. We're looking at massive regulatory shifts coming out of the U.S. And finally, Wall Street heavyweights literally buying their way into the crypto ecosystem.
And the mission for our deep dive today is to walk you through exactly how that happened. Chronologically, day by day over the past week, we're going to connect the dots for you. We'll start with the global shocks we saw over the weekend, then look at the shifting regulatory stance from the CFTC and the SEC, and then map out how those changing rules directly resulted in multi-billion-dollar moves by the Federal Reserve and the New York Stock Exchange.
Yeah, because when you look at these events in isolation, they might just seem like, I don't know, standard financial news.
Exactly. But when you string them together, you witness a complete rewiring of global finance.
Okay, let's unpack this. We have to start with Monday's newsletter, which was essentially a recap of the trial by fire that took place over the preceding weekend. We saw global geopolitical tensions hit a total fever pitch.
A very tense 48 hours.
Extremely. This involved the U.S., Israel, and Iran. And there were even widespread reports circulating about the death of Iran's supreme leader. It was an incredibly volatile, fast-moving situation. But what stood out from a financial perspective is what happened in traditional markets, or I guess what didn't happen.
Right. And that is the crucial starting point for this entire week's narrative. When global news of this magnitude breaks on a Saturday or Sunday, traditional markets are completely paralyzed.
They're just frozen.
Exactly. If you're an institution holding CME gold futures, the market is closed. The traditional equities markets are closed. So investors who desperately needed to hedge their risk or react to this shifting geopolitical landscape had absolutely nowhere to go in the traditional banking system.
Because of that structural limitation, crypto became the absolute only venue for real-time global price discovery. I saw in the notes from our newsletter that tokenized assets, specifically PX Gold and Tether Gold, stepped in to provide essentially 100% of the weekend's price discovery.
Yeah, they carried the whole load.
But I want to play devil's advocate for a second here. If the actual physical gold markets are closed in London and New York, how does a digital token prove what gold is actually worth on a Saturday afternoon?
It's a great question, and it really gets to the heart of why decentralized exchanges are so powerful. Even though the traditional vaults and centralized commodities exchanges were locked up for the weekend, the human desire to trade based on new information doesn't just stop.
People still need to make moves.
Exactly. Platforms like the Hyperliquid Exchange operate 24 hours a day, 7 days a week. So buyers and sellers of these gold-backed tokens like PayX Gold were able to find each other on-chain and negotiate a price in real time.
Oh, I see.
They are essentially establishing a shadow price for gold based on live global events, entirely outside the legacy financial system.
And it wasn't just gold-pegged tokens reacting either. Bitcoin really acted as a global risk proxy during those 48 hours. We saw it rebound back up to $68,000 as traders started betting on a potential de-escalation of the conflict following those reports of a leadership vacuum in Tehran.
Which is why this wasn't just a temporary price bump, it was a live stress test. For years, proponents of blockchain technology have argued that financial markets shouldn't take weekends off. This event validated that necessity on a global scale. The infrastructure worked seamlessly, handling massive volume, precisely when traditional finance was effectively turned off.
Now, there was a seemingly small detail tucked away in Monday's news that I really want to bring up because it sets the stage perfectly for the institutional wave we see later in the week. Morgan Stanley filed with the OCC for a de novo national trust bank charter, specifically to custody crypto. Wait, what does de novo actually mean in this context?
De novo essentially translates to from scratch.
Okay.
So instead of Morgan Stanley partnering with an existing crypto custodian or acquiring a smaller startup, they're asking the government for permission to build a brand new purpose-built bank entirely from the ground up just to hold digital assets.
Wow.
It shows a massive level of long-term commitment. They watched that weekend stress test and they are building the plumbing to participate.
So the weekend proved the infrastructure is bulletproof under pressure. But going into the work week, the broader crypto market was actually in a bit of a slump on Tuesday, March 3rd. However, we highlighted a massive outlier in the newsletter, the Venice token, ticker symbol VVV. It rallied 20% on a down day, pushing its market cap up to almost $300 million.
Venice is a fascinating project. For some context for you listening, it was founded by Eric Voorhees, and it operates as a privacy-first, permissionless AI platform.
Right. Essentially, it's an uncensored alternative to models like ChatGPT running open-source large language models. But they really boast about having zero data retention. What does that actually mean for the everyday user? And I guess, why does it matter enough to drive a $300 million valuation?
Think about how standard AI models work today. When you type a prompt into a mainstream AI, that company often stores your data, analyzes it, and uses your personal queries to train their next generation of models.
Right, you're the product.
Exactly. Zero data retention means Venice physically does not save your prompts. Once the session is over, the data is gone. It's a massive selling point for enterprise users, or really anyone concerned about data privacy. They also recently became the recommended model provider for OpenClaw, which is a major evaluation framework for testing AI performance.
But Vitalik Buterin recently criticized the flood of speculative, frankly useless AI community tokens that just burn out quickly. How does Venice avoid falling into that trap?
Because of actual tangible utility, this isn't just a meme coin with AI slapped on the label. Users actually stake the VVV token to earn yield and gain zero marginal cost API access.
Oh, interesting.
Think of staking it like buying a lifetime subscription that you actually own and can sell later. Alternatively, users can mint something called Diem, which gives them perpetual daily API credits. The token is deeply integrated into the platform's daily usage.
And the tokenomics driving this surge are designed to create a serious supply crunch, right? They cut their annual token emissions from 8 million down to 6 million. On top of that, they implemented a revenue-funded buyback and burn mechanism.
Which means, as the platform generates revenue, they use that money to buy their own tokens off the open market and permanently destroy them. Decreasing supply meeting increasing demand.
Have a powerful combination.
Very. And Venice wasn't the only one building that Tuesday. NASDAQ made its first real move into prediction markets. Meanwhile, MicroStrategy, which is practically an infrastructure player at this point, given the sheer size of their holdings, scooped up another 3015 Bitcoin for over $204 million.
So Tuesday showed us the underlying technology and utility maturing. But tech is essentially handicapped without rules. That is why the absolute bombshell that dropped just 24 hours later on Wednesday, March 4th, is so critical. The regulatory floodgates officially opened.
They really did.
CFTC Chairman Michael Selig laid out a roadmap to bring crypto perpetual futures onshore, aiming to do it within just a few weeks.
This represents a monumental pivot for the United States. What is happening here is part of something called Project Crypto. It's a joint initiative spearheaded by CFTC Chairman Selig and SEC Chairman Paul Atkins.
Okay.
Their explicit goal is to harmonize federal oversight of digital assets. We are finally moving away from the prior administration's approach of regulation by enforcement and moving toward establishing a clear, harmonized framework.
Let's break down the asset itself, because perpetual futures sounds incredibly dense to anyone not trading them daily. As I understand it, they are wildly popular because they let traders hold leveraged positions indefinitely without an expiration date. But right now, almost all of that trading volume happens on offshore exchanges, right?
That is correct, and that offshore dynamic is exactly what the regulators are targeting.
So let me try an analogy here. Think of offshore perpetual futures, like a massive high-stakes casino sitting on an island just outside U.S. jurisdiction. All the trading volume, all the liquidity is flowing out of the country to that island. What the CFTC is basically saying is, let's build a regulated casino right here on U.S. soil so we can set the rules, monitor it, and protect the players. Is that a fair way to look at it?
It is a perfect analogy. By establishing clear rules, things like leverage caps to prevent reckless borrowing and enhanced transparency requirements, the U.S. intends to completely recapture that massive liquidity.
Bring the money home.
Exactly. They want those trading fees and that market influence back within their borders. By providing that clarity, they are actively cementing the U.S. as a global crypto hub.
And as we always discuss, regulatory clarity is the exact green light that traditional institutions have been waiting for. They have trillions of dollars in capital, but they refuse to deploy it until the rules of the road are clearly defined, which tees up Thursday, March 5th, perfectly.
A historic day.
Truly. Kraken Financial officially secured a Federal Reserve master account. They were the very first digital asset bank to achieve this.
This is a headline that might sound a bit dry if you don't know the underlying plumbing of the financial system, but it's a massive milestone. It means Kraken now has direct access to Fedwire.
Just to clarify for you listening, what is Fedwire compared to normal banking?
Fedwire is the core interbank payment network operated by the Federal Reserve. It processes over $4 trillion in average daily fund transfers. Historically, any crypto company had to rely on intermediary correspondent banks to handle their U.S. dollar transactions.
Right, bouncing through middlemen.
Exactly. If a customer wanted to wire money to a crypto exchange, it had to bounce through a traditional bank first. Now, Kraken can bypass those middlemen entirely for direct U.S. dollar settlement with the central bank. It drastically speeds up deposits and withdrawals, which is vital for their institutional clients.
But wait, didn't the traditional banking sector absolutely freak out about this? I remember reading that banking lobbying groups cited systemic risks. Are they just being sore losers about facing new competition, or do they actually have a point about the dangers of plugging a crypto company directly into the U.S. financial plumbing?
There is definitely nuance there. Traditional banks are absolutely feeling the competitive heat, which drives a lot of their complaints. However, the Federal Reserve recognized the novelty of this and didn't just hand Kraken a blank check.
Okay, so there are guardrails.
Major guardrails. They place strict limitations on this master account. Kraken will not earn interest on its reserves held at the Fed, and crucially, they do not have access to the Fed's emergency lending facilities. If Kraken gets into trouble, the Fed is not going to bail them out. So it is a huge step forward, but it is a carefully guarded one.
Still, the timing is impeccable. Kraken is reportedly prepping for an IPO at a $20 billion valuation. You have the regulators clearing the way for onshore trading on Wednesday, and then Kraken getting direct Federal Reserve access on Thursday.
It proves that regulatory clarity is rapidly translating into legitimate core financial infrastructure. The space is being legitimized for capital at a scale we simply haven't seen before.
Speaking of the sheer amount of capital floating around this space, I have to toss in a detail from Thursday's newsletter. Tether, the company behind the massive USDT stablecoin, strategically invested $1.5 billion into a smart mattress company called 8 Sleep. I have to ask, why does a stablecoin company care about health intelligence data and mattresses?
It's a striking detail, I agree, but it makes total sense when you look at their balance sheet. Tether generates billions of dollars in yield from the U.S. Treasuries backing their stablecoin.
They just have that much cash.
Yes, they are producing so much excess capital that they are essentially acting like a sovereign wealth fund at this point. They are diversifying massive treasuries away from purely digital assets and acquiring tangible, real-world technologies. They're placing bets on the future of health, energy, and AI.
Okay, that brings us to the climax of the week. Friday, March 6th. Wall Street officially steps into the arena. We reported that Intercontinental Exchange, commonly known as ICE, which is the parent company of the New York Stock Exchange, invested in the OKX crypto exchange at a staggering $25 billion valuation.
This is the ultimate convergence of traditional finance and decentralized finance. If we look at how this deal functions, the synergy is incredible. ICE is getting a board seat at OKX, but more importantly, they are getting access to OKX's spot pricing data. ICE is going to use that data to launch their own U.S.-regulated crypto futures.
And in return,
and this is the wild part, OKX is going to distribute ICE's futures and tokenized equities tied directly to the New York Stock Exchange. And they are offering these to OKX's 120 million global users.
let's pause on that because here's where it gets really interesting. We are talking about tokenized New York Stock Exchange equities. This means someone sitting halfway across the world who might never be able to open a traditional Charles Schwab or Fidelity brokerage account can now trade fractional shares of American companies on a crypto exchange, 2047.
It democratizes access completely.
The market reaction was instantaneous. The OKX native token, OKB, surged over 36% on the news.
When you tie this whole week together, the momentum is just undeniable. On Monday, a weekend geopolitical crisis proved that 247 blockchain technology functions perfectly when traditional systems fail. On Wednesday, regulators signaled that the rules of the road are finally being established.
Set the stage.
And by the time we hit Friday, we saw the momentum of things like the Clarity Act materializing into the apex of traditional finance, the parent company of the NYSE partnering with a massive crypto exchange to merge their product offerings.
So what does this all mean for you listening? Let's synthesize everything we've covered today.
What truly mattered this week is that the broader narrative has definitively shifted. For a decade, crypto was viewed by the mainstream as a highly speculative fringe asset class. This week provided tangible proof that crypto is becoming the new, government-sanctioned core plumbing of global finance. This integration between Wall Street and blockchain is no longer a theoretical future state. It is happening right now.
Exactly. And because of that massive macro shift, it is also important to point out what was just noise this week. You can safely ignore the daily microfluctuations of NFT floors. We noted in the newsletter that a top holder of pudgy penguins was relentlessly dumping their collection, and node bunks were bouncing around by 9 to 12% a day.
Yeah, totally irrelevant in the grand scheme.
When the foundational plumbing of global finance is being rebuilt, cartoon JPEGs are just noise. Also, you can probably tune out the distant promises from traditional banks trying to play catch-up. There was news about a consortium of EU banks called Quavalis advancing a plan to launch a euro-pegged stablecoin, but they are targeting the second half of 2026. By the time they launch, the market will have already moved light years ahead.
That is spot on. As for what you should watch next, keep your eyes on how traditional legacy banking incumbents react to all of this over the coming months. We saw them try to push back against Kraken getting direct Federal Reserve access. Will they continue to fight back and aggressively lobby against this integration, citing systemic risks? Or will they capitulate, realize they are rapidly losing market share, and partner up, exactly like ICE did with OKX?
That tension is going to be the main story.
That tension between the old guard and the new infrastructure is going to drive the next massive wave of news.
It's going to be fascinating to watch play out in real time.
I want to leave you with a final provocative thought to mull over. If the parent company of the New York Stock Exchange is now willing to tokenize equities and distribute them seamlessly to a crypto exchange's 120 million global users, what happens to the traditional neighborhood stockbroker? What happens to legacy brokerage firms when they suddenly have to compete with a global, completely frictionless market that never sleeps, never closes for a holiday, and settles instantly? The disruption we're about to see in retail finance is going to be unprecedented.
That is a brilliant question to end on, and something we will definitely be keeping a close eye on. A massive thank you to you, our listener, for taking the time to join this deep dive today. We know your time is valuable, and we really appreciate you spending it with us as we navigate these massive historic market shifts. If you want to stay ahead of the curve and get these insights daily, make sure you are following Nifty Noon on X and subscribing to our newsletter on Substack. Until next time, stay curious.